The Intelligent Investor is a classic investment book written by Benjamin Graham, first published in 1949. It is widely regarded as one of the most influential books on value investing and has been praised by many successful investors, including Warren Buffett. The book's main theme is the concept of value investing, which involves buying stocks that are undervalued by the market and holding them for the long term. Graham stresses the importance of a disciplined, patient approach to investing and warns against speculation and following market trends. One of the strengths of the book is its accessibility. Graham uses clear and straightforward language to explain complex concepts, making it easy for readers to understand his investment philosophy. He also provides practical advice on how to analyze financial statements and evaluate stocks, which is still relevant today. The book also emphasizes the importance of risk management and diversification. Graham advises investors to spread their investments across different asset classes and companies to minimize the risk of losing money. However, it's worth noting that The Intelligent Investor was written more than 70 years ago, and some of the examples and strategies used may no longer be applicable in today's market. Additionally, the book focuses primarily on the stock market and doesn't cover other types of investments, such as real estate or bonds. Here are 10 key takeaways from The Intelligent Investor. The difference between investing and speculating. Graham emphasizes the importance of investing for the long term rather than speculating based on short-term market trends. Speculating in stocks refers to the act of buying and selling stocks based on predictions or expectations of short-term price movements, rather than investing in a company for the long term based on its fundamental value. Speculators typically try to profit from market fluctuations by buying and selling stocks quickly, often taking on high levels of risk in the process. Speculating in stocks is generally considered more risky than investing, as it relies on short-term price movements that are difficult to predict accurately. Investors who engage in speculation may also be more prone to making emotional or impulsive decisions, which can further increase their risk of losses. In contrast, investing in stocks involves a long-term approach to building wealth through owning a stake in a company. Investors base their decisions on factors such as a company's financial health, industry trends, and growth potential, with the goal of achieving long-term capital appreciation and income. This approach typically involves lower levels of risk and requires a more disciplined and patient approach to investing. 2. The concept of margin of safety. Graham recommends buying stocks with a margin of safety, which means purchasing them at a significant discount to their intrinsic value to minimize the risk of loss. 3. The importance of diversification. Graham stresses the need to diversify investments across different companies and asset classes to minimize risk. Diversification is important in stocks because it helps to minimize the risk of losses in an investment portfolio. When investors diversify their investments across different stocks and sectors, they reduce the impact of any one stock or sector on their overall portfolio. This means that even if one stock or sector experiences a decline in value, the losses are offset by gains in other stocks or sectors. For example, if an investor puts all their money into one stock and that stock experiences a significant decline in value, they risk losing a large portion of their portfolio. However, if the same investor diversifies their investments across different stocks and sectors, the impact of any one stock or sector on their overall portfolio is reduced. Diversification can also help investors to capture opportunities in different sectors and markets, providing the potential for higher returns over the long term. Additionally, it can help to manage overall portfolio risk and provide a more stable return on investment. 4. Learn how to analyze financial statements. The book provides practical advice on how to read and interpret financial statements, including income statements, balance sheets, and cash flow statements. 5. The dangers of market forecasting. Graham warns against trying to predict the future direction of the market, as it's impossible to do so with any degree of accuracy. While some investors may rely on market forecasting to inform their investment decisions, there are several dangers associated with this practice. The future is inherently uncertain, and no one can accurately predict the direction of the market with complete accuracy. Attempting to do so can lead investors to make decisions based on flawed assumptions, which can result in losses. Investors who rely heavily on market forecasting may become overconfident in their predictions, leading them to take on more risk than they should. This can result in large losses if the market does not behave as expected. Confirmation bias. Investors may become more likely to seek out information that confirms their existing beliefs, rather than considering alternative viewpoints. This can lead to a distorted view of the market and an over-reliance on flawed assumptions. 6. The importance of rational decision-making. Graham encourages investors to approach investment decisions rationally and objectively, rather than being swayed by emotions. Rational decision-making is essential for making sound investment decisions in the stock market. This approach involves weighing the potential risks and rewards of an investment and making decisions based on objective analysis and evidence, rather than emotions or impulsive reactions. 7. The benefits of dollar-cost averaging. The book recommends using dollar-cost averaging to invest a fixed amount of money regularly over time, which can help to smooth out market fluctuations. Dollar cost averaging is an investment strategy that involves investing a fixed amount of money at regular intervals, regardless of the asset's price. The idea behind DCA is to reduce the impact of volatility on an investor's portfolio by spreading out the investment over time, rather than investing a lump sum all at once. For example, suppose an investor decides to invest $500 in a mutual fund every month for 6 months. In the first month, if the mutual fund's price is high, the investor will buy fewer shares. But if the price is low, they will buy more shares. Over the course of the 6 months, the investor will end up with an average price that is less volatile than the price on any single day. Dollar cost averaging is a long-term investment strategy and can be used for a variety of assets, including stocks, bonds, and mutual funds. It can be a useful tool for investors who want to invest in the stock market but are afraid of timing the market or don't have a large amount of money to invest all at once. 8. The role of bonds in a portfolio. Graham suggests using bonds as a way to reduce overall portfolio risk and provide a steady stream of income. Adding bonds to a portfolio can help diversify the portfolio and reduce overall risk. Bonds often have a negative correlation with stocks, which means that when stock prices go down, bond prices tend to go up. This can help cushion the impact of a stock market downturn on the overall portfolio. Bonds pay interest, which can provide a regular income stream for investors. This can be particularly important for investors who are in or near retirement and rely on investment income to supplement their other sources of income. Bonds are generally considered to be less risky than stocks, and they offer a lower rate of return. However, this lower rate of return comes with a higher degree of capital preservation. Bonds are generally less volatile than stocks, and investors can be reasonably confident that they will receive their principal back when the bond matures. Bonds are generally more liquid than stocks, meaning that they can be bought and sold more easily. This can be particularly important for investors who need to raise cash quickly or who want to make changes to their portfolio. 9. The dangers of leverage. Graham cautions against using excessive leverage, as it can magnify losses and lead to financial ruin. Excessive leverage in stocks refers to a situation where an investor borrows too much money to buy stocks, resulting in a high level of debt relative to their equity. Leverage, or using borrowed funds to invest, can magnify gains but also amplify losses. For example, let's say an investor uses $100,000 of their own money to buy stocks and also borrows an additional $400,000 from their broker to invest. This means they have a leverage ratio of 4 to 1. If the stock market goes up 10%, the investor's gains will be magnified to 40%. However, if the market goes down 10%, the investor's losses will also be magnified to 40%, leaving them with a significant amount of debt to pay back. Excessive leverage can lead to a situation where an investor has more debt than they can comfortably manage, which can put their financial stability at risk. Additionally, if the stock market experiences a significant downturn, an investor with excessive leverage may be forced to sell their stocks at a loss in order to repay their debt. 10. The need for ongoing education. The book emphasizes the importance of ongoing education and self-improvement for investors, as markets and investment strategies are constantly evolving. There are many books on investing that can provide valuable information on topics such as fundamental analysis, technical analysis, and risk management. Some popular books include One Up on Wall Street by Peter Lynch and The Little Book of Common Sense Investing by John C. Bogle. Many online courses are available that cover various aspects of investing in stocks, such as financial analysis, portfolio management, and risk assessment. Some popular online learning platforms include Coursera, Udemy, and Khan Academy, and of course, watching bank on it videos. Overall, The Intelligent Investor is a timeless classic that provides valuable insights into the principles of value investing. While some of the strategies may need to be adapted to suit the modern market, the book's core philosophy remains relevant today. It's a must-read for anyone interested in investing and a valuable addition to any investor's library.